everyone. My partner, Brooklyn Jacks, and I were Company D in the business strategy game. And I am here to tell you about our performance throughout the game. Now, we did struggle slightly, but I believe we had a pretty realistic go through when it comes to running a company because we started off pretty good and then we didn't do as good. Our stock started to decline, our profit started to decline, and we thought we were eventually going to go bankrupt. But we revisited our strategy and we started to make more sales and finally hit our growth phase. Now I'm going to be discussing our financial performance and our strategic vision, and then my partner is going to take over the rest of the slides. The topics of our financial performance that I'm going to be discussing with you is the net revenue, the earnings per share, the return on equity, the credit rating, the stock price, and the image rating. Now for our net revenues, as you can see, our internet revenues for year 10 started off at $90,315. And then in year 11, we had a significant increase to $137,644. And then we had a decline in year 12, and then another increase, and then another increase. And this is where we thought we were doing good until somewhere along the lines we made a mistake and our revenues decreased dramatically, almost down to what our starting revenues were. And then we finally hit our stride, I believe. We started to redo our strategy, and as you can see, our profits totally benefited from it. Now, we did not make any private label sales. That was just something we could not figure out, but I don't think it personally hindered us. And from what I can tell, a lot of other companies did not make any private label sales. So for our earnings per share, I have this nice table. And as you can see, it better shows our rises and our falls. Here, years 10 through 12, our stocks remained pretty consistent in the $2 range. We finally broke over $3 in year 13, and it kept rising for year 14. Year 15 and 16 were our tough years, and that's where we had our dramatic decreases, until we finally, I believe, hit our growth phase and made it up to $12.92. And I believe if we would have kept playing this game, we would have been able to get our earnings per share even higher. So this table shows our return on equity. Here, year 10 through 12 again, pretty calm. Our only high was in year 11, which was 21.40. Then in year 13, we have a pretty dramatic rise from 26.8 to 29.2. And then we have our dramatic drop, which drops us down to 15.6. And then in year 17, we managed to get out of the hole and get up to 27.1, 29.6, and finally at our highest, 35.6. This is the one thing that remained completely consistent throughout our game. And I believe it benefited us when we had to take out loans, because our credit rating always remained at an A+ from year 14 onward. And if you remember from our previous slides, we struggled around year 14 and year 15. So I believe if our credit rating would have even struggled a bit, we would have had to pay far more interest, and it would have been a lot more difficult for our company to get out of the hole. On this slide, I'm going to be discussing our stock price and its performance. For years 10, 11, and 12, we managed to get our stock prices between $38.55 and $73.14, although we did have a dip where our stock price was $28.56, which is the lowest it's been. Our stock price did have a small growth period and then a sharp dip due to a few years where we struggled. We then finally hit our stride and had good growth. Year 16 through 19, you can easily see that our stock prices kept going up and up. And at year 19, we hit our highest stock price in the history of our company so far, which was $290.72. Now, our image rating also suffered quite a bit. We were not the most popular company, and we were also not the most environmentally friendly company, so I can understand why. And our shoes were rather expensive, but they were of a good quality, which later on people eventually started to see. Now, year 10 through 11, you can see a steady rise. And then year 11 through 14, you can see it's just declining steadily, not by much, usually by 1 or 2 points. And then year 14 through 15, there's a dramatic decline from 71 to 68. In year 15, we start to finally start going back up. And this is where I believe we're starting to hit our plateau, where it might just even out at around 88, or possibly we could get higher, but I don't believe that would have happened. Our company's strategic vision is that we wanted to be the first choice in superior quality shoes worldwide, and to be as cost efficient as possible. We wanted to make sure that we are producing quality shoes that are also comfortable as well as eco-friendly. Those were our top priorities. Now, we did sell shoes worldwide. We did not focus on any particular region, although it took us a while to start selling shoes in Latin America, and we mainly sold shoes to Asia, the Asia Pacific region. Our shoes were cost efficient to produce, but they were rather expensive for the consumer, sometimes ranging from $88 to $90. But they were of a good quality. Usually they were about 77% superior quality, and the rest was just normal quality. Our shoes were not very eco-friendly, but they were not the worst you could get for the environment. As I said earlier, I believe if we would have continued the game, our profits and everything else would have steadily risen, except for our image rating, which I believe would continue to start plateauing at about 89.90. So in year 20, I believe our earnings per share would have gone up to 13.82. And in year 21, it would have gone up to 15.82. Our return on equity would have gone up to 40.2. Then 45.8 in year 21. Our credit rating would be the one thing that would remain consistent and stay at A+, because it was rather consistent throughout years 14 through 19. Our image rating would have gone up to 89 and then 90, and I believe it may have stalled around here unless we made more changes to become environmentally friendly, which I believe we would have. And then our stock price would have risen to $300 and then to $315. Unless we had another dramatic decline, like in years 13 through 14, but I don't believe that would have happened. Now I'm going to be giving you guys over to my partner, Brooklyn Jacks.
For my portion of the presentation, I will mainly be discussing all the different types of strategy that we use throughout the game. So our market strategic overview, production strategy, our company's finance strategy, internet competition, our wholesale competition, our competitive advantages that we think that we have over companies, and all of the lessons learned. So as Miracle stated earlier on in the presentation, that we kind of struggled throughout the game. And even though we did still end up in last place for the most part, we really made a lot of progress, and we definitely learned so much on what to do and what not to do, and I think that really showed in the end. So the first market strategy overview that I am going to be talking about is our internet marketing. So for our internet marketing, I have provided you our data for every facility that we had in all 4 different geographical regions. So as you can see, our SQ rating was always above 50%. and it steadily increased over the years once we started selling more pairs of shoes. So we mainly started off about a 5.1 to 5.2 in each country, and over the years, especially in the last 3, we were able to get that up to about 8.6 in the rating. So our company kind of hit a pretty rough patch in year 15. We lost a lot of money and we weren't really selling that many pairs of shoes. We were able to continue selling more than before after we hit that rough patch, luckily. Our market share fluctuated over the years for every different country and facility that we were in. So we never really had a strategic process for that. It just kind of fluctuated, and we were able to end on a high note for each country in our year 19. We were able to slowly increase the retail price each year, making sure that it exceeded the wholesale price by at least 40% in each one of those countries. The second strategy that I will be discussing is our wholesale marketing strategy. As for our wholesale marketing, our number of pairs sold definitely vary and change throughout the years. We didn't experience very steady growth. We ended on a high note, selling the most pairs to all consumers in year 19 between the 4 countries. Like I mentioned previously, year 15 was a hard year for us, but we were able to rebuild the company and sell to more stores than ever before. It was very important to us to try to keep the price as low as we could, so more consumers were able to afford our product. But once we started selling higher quality products, we slowly had to increase the wholesale prices. We were able to have our delivery time be only 1 week since they ordered, so consumers could receive the items quicker to sell to the customers. The third market strategy that I will be talking about is our private label marketing. So as you can tell, we did not sell any private label shoes throughout the entire game, which probably hurt us in the long run. But the reason why we did this was because we honestly could not figure out a great strategy or a great way to incorporate this into our company. Every time we tried to incorporate it with our numbers, we had a decrease in revenue, or we had a decrease in our earnings per share or return on equity. And so for us, our strategy was to make sure that we had the highest numbers in those, or for those categories. And so whenever we would manipulate and try to incorporate private label shoes, the numbers just weren't adding up and it wasn't successful for our company. Potentially, if we would go on throughout the years, we might be able to, since we are doing better now in year 19 than we had in any of the other previous years. But I just wanted to show you guys what we did for our private label shoes and that we actually did not sell any at all. Next, we will be discussing production strategy. So as you can see from the graph that I provided, North America was our highest and most productive warehouse, and we were able to use them and sell shoes through them through the entire time from year 10 to year 19. It wasn't until year 16 that we were able to get a Latin America warehouse, but overall I think that having the one profitable warehouse was successful for us. Each facility varied from about 500 to 1,000 workers, so naturally we built bigger facilities for the larger distribution warehouses. Our main priority was to reward workers for all the hard work they did for our company. Our wages, incentive pay, benefits, and our overall total compensation package was always over the industry average. Making sure that we invested into our employees was very important, and we always provided additional training when they needed it. In the future, making sure that we lowered our production costs would be an absolute top goal for us. As Miracle stated before, we potentially almost could have gone bankrupt in the earlier years of our business. Luckily, that did not happen, and we were able to regain revenue and increase our sales. But something that was really important to us and our financial strategy was basically our loans. And we took out several small loans, either 1 to 5 years, nothing longer than that. And we always made sure to pay them off as quick as we could. And I think that was really beneficial to us in our company. We always wanted to make sure that the risk of debt ratio was very low, and I think this really helped us overall. We were able to get stock and then also buy our stock back between the years, and I think that that really helped us keep afloat for most of our years that we were struggling. So at the beginning of the game, we really didn't have a lot of close competitors, but since we worked really hard and got all of our numbers up, I really think that we made some really good strides and we got pretty close to some of our competitors. So our 3 top competitors in the internet market competition is going to be Cool Kicks, FS&R Footwear, and G Company. Although they still were able to have a higher advantage, we were still very close in the race. For the wholesale competition, and like on the previous slide, I think that we kind of remained in the same space as the internet competition, and so once again our 3 competitors are Cool Kicks, FS&R Footwear, and G Company. These 3 companies have been our biggest competitors, and they have done a great job competing in this game. I am super proud of us that we took the strides that we needed to get back to a competing level with them. A few actions we could take to potentially have the upper hand would be to increase our earnings per share. Also, to increase our overall stock issue would help a lot too. These 2 categories have held us back in the competition. Some of our facilities also have very high operating costs, so making sure that we find a way to reduce them would be very beneficial. Being able to reduce our prices for internet and wholesale marketing would also help us make us be a more desirable company and give us a competitive edge over these other companies. So the final stage of this presentation is the lessons learned, and I think that we learned so many things throughout this project and this game. So many things that I would do differently, and I'm sure Miracle would do differently too. A few things would just basically to make better financial decisions. I don't think that we fully grasped how much everything would cost and how big of loans we should take out, how little of loans we should take out, how quickly to pay them off. I think that we would really have a better understanding of everything now than we did in the very beginning in year 11. Another thing would be to create superior quality products. So towards the end, we really upped the quality of our products, but I think it would be really important to do that early on. We were either doing half and half of superior to standard, and it didn't really help our credit rating at all, or image rating. It was very low throughout most of the game, and so once we finally started to change that and up everything in year 18 and 19, we saw drastic change, and I think that if we just decided to do that a little sooner, then we would have made a lot more profit in the end. The next thing is to find ways to operate our facilities. And so basically, I don't think we had great strategy for our facilities and our locations. I think that we didn't really think about that as much as we should have. I personally didn't know when would be a great time to buy new products for our company and when to buy new facility equipment, or if we should buy refurbished. Definitely was a struggle for me, just because I didn't know the correct times and if we had enough, and I was really trying to up our revenue and make sure we had a lot of ending cash, and so every time we manipulated those numbers, everything would decrease. And to us, our most important goal was to try to stay afloat in the competition, and so sometimes we didn't get a lot of stuff for our facilities that we might have needed in the future. And our last thing is to establish clear objectives and goals. So every time it was a new year, we just tried to up everything as much as we could. We didn't really have a plan or goal. We would just really try to increase our sales, and I'm not sure if everyone else did that as well, but I think that it would have really helped us, especially in the 3-year plan, if we would have said, this is what we're trying to do, these are the goals that we want to accomplish, and we really stuck to that instead of fluctuating and trying to figure out how to get everything to the maximum. So thank you guys so much for watching me and Miracle's presentation. It was a great time playing with you guys, and good luck.